Greetings, everybody. My name is Matthew Guarini, and I'm the Executive Director of the TBM Council, and I'm here with Howard Rubin. Howard?
Pleased to be here again. I love talking to you, Matt.
I love having you on board. Howard and I are hosting the Real ROI of Tech. It's our podcast. This is our 4th episode. And one of the big things that's popping up all over is tokenomics. And so, Howard, a lot of people hear the word, they throw the word around. I don't know if everyone really knows exactly what it is. Can you give us, from your academic and experience base, what tokenomics is and why it's important?
Yeah, I think tokenomics is representing a shift in what people are spending on IT, because you used to know what you're spending for infrastructure, your servers, what you're paying for developers and things like that. And cloud started touching a little bit on tokenomics kind of stuff by paying by the drink for virtual images of VPUs and stuff like that. But suddenly what the main part of what your work is doing is sort of paying by the drink, and that's what the tokens are about. So the big shift is it's a large part of IT spend can be consumption-based charges, where it's hard to estimate what that consumption is, and lo and behold, what the value of that consumption is. And that's why you start to see the headlines about Uber or Microsoft starting to blow their budgets, because they have no plan to understand what level of consumption they might have, and they're paying by things by the drink. It's like giving a kid a cell phone for free and charging them for streaming by the minute. And you never know where it's going to end, and you don't know what the value is. And that's the control mechanism is there. Control may be the wrong word, but the overall mechanism is right there.
So let's deconstruct 2 examples that are out there real quick around tokenomics and challenges. So in the last podcast, we talked about how do you measure value. And it's interesting because at the end of that podcast, you had mentioned how, a lot of people were out there just measuring, how much they're using, consumption, things like that, the vanity metrics and things like that, rather than the outcome metrics. And so Microsoft recently just pulled back from their Claude initiative. And one of the reasons, and I want to say, I think it was, I forget the company, it was either Meta or one of those, who actually got rid of their consumption leaderboard. And in both of these cases, they were using consumption as a way of measuring how much they were doing rather than the value that we're getting. What are your thoughts on that?
Yeah, and I just recently published something that I basically call the 5 principles to avoid a technology cost crisis, because what you're talking about with those are technology cost crisis. And you started in the perfect place, because number 1, measure the business value before measuring consumption. You've got to know what you're trying to get out of this. Number 2 is understanding your token costs and what economics can you afford on this kind of stuff. It's almost like what can you afford for rent and stuff like that, and understand the bounds of what you might be able to afford. But then you have to figure out what you're affording based to something. So you have to start dealing with understanding unit economics. It's going to be everything at a high level of what you can support per revenue per million tokens or customer interactions and so on. And then this stuff has an architecture in terms of the way all the layers and stuff you're doing with what you're using the AI and large language models and others for. And Matt and I have discussed fit for purpose, but really understand before scaling, understand the components of what you're dealing with, the premium cloud GPUs and all the cost elements. And then number 5 is introduce the technology cost of capital, because you have options of spending this money on something else. So the 5 basic principles goes back to things Matt and I have talked about. Said you start from the outside in. I mean, why are you doing this? Where do you expect to get value? What can you afford to spend on this stuff, and understand what the bounds are if you have to go higher, because you can't crush your earnings per share. Next is to figure out your unit economics of what you're doing in a new way, then understand how you optimize the architecture of using that, then understand the trade-offs you're making, which I would call technology cost of capital. I hope that doesn't sound too esoteric, but those are the things you need to do to avoid a cost crisis, like having, being homeowner rich, but you're spending too much for your mortgage. I don't know if that's a good example or not, Matt, but
I think it's good. I think it's a good example. I think it's a bit of what you see with the second case that we mentioned was Uber, right? So Uber blows through their budget by April. They have a situation where they're saying that they're getting value from it, but obviously, how do you balance that, right? It's great. If you're saying you're getting loads of value and you can demonstrate that, then the business should be willing to invest even more. But there's got to be a point where while they feel like they're getting value, maybe it's only perception.
Yeah, value has to exceed the cost to make it worthwhile. There's a trade-off. And there's also the factor of risk. And risk is a big thing with these large language models because you see the liability and everything around using these models isn't known. Even on the news today, there's the use of AI. Someone got arrested because a large language model identified his face, 93% as being someone who committed a crime, and now they're being sued because of this. So there's some risk associated with it. There's the cyber risk when you're doing AI coding. There's a long-term cost of things. And we even have clients that we're working with that have said these models are getting so expensive, so it's easy to use offshore labor and get production systems than it is to build it with the AI coding and spend all the money on tokens.
Well, and then that's interesting because, that was a model we've used in the past, right? When the first offshoring firms really took off in the early 2000s, it was an indication that rather than using onshore resources, we could use the power of the Indian firms. Now we're in a situation where whether it's India or other locations, there's opportunities to parallel process with humans versus the AI if the cost is that much of a delta compared to what you're getting on the value side of things.
Yeah, and there's one interesting thing, and even with my working with AI models, and I taught this stuff for years in the university, if you query the AI models themselves about where human intervention is required, they said human intervention and supervision, adult supervision is needed for anything you're doing that's absolutely critical. So even looking at the cost of this stuff, beyond the tokens is what's the cost of the human involvement? Because this stuff isn't on autopilot. When you're using stuff for development, sure, it accelerates your rate, but you're building up technical debt faster than you know what to
Yeah.
do with. So this whole trade-off isn't just a point in time, shot in time, quick hit. There's a long-term commitment to this stuff and making it work and creating, I'm trying to think of the word, enduring value out of it, but also knowing when the value shows up. So that's the issue. So tokens are consumption-based stuff is not new to IT, but not so much as the long-term and a bigger part of spending it is right now.
So on the token side, there was an announcement about a week or two ago about the Tokenomics initiative in Linux, right, and the Linux Foundation. So they're going to explore all things around tokenomics. But I think we are starting to see. You mentioned the people that are using labor to get around some of this, but I've also seen where people are using smaller models that are built fit for purpose. I've also seen cases where people are doing things on-prem and they're keeping more of the fixed nature of that expense. So I think the phrase that we introduced at the last podcast was this idea of hybrid AI, where you want to develop the best model that's fit for purpose and apply the different solutions. In that case, tokenomics is very important still, but it's not the only way you're going to run your business, correct?
That's right. And what you said there, which leads the way to the hybrid models, is fit for purpose. Fit for purpose means there's not the proverbial one shoe fits all or whatever that is, one size fits all thing. So that's literally it. So you're going to have to do some exploration in terms of what you're doing, even across all the different models. You talk about SLM, LLM, and things like that. Choose the model. And underneath those models, if you're doing stuff in-house, understand that you have choice of chipsets and other things to do. So you don't need the maximum horse. You don't need every car to have 1,000 horsepower, be it go 0 to 60, under 2 seconds or something. So you choose the vehicle you need to get the value carefully. You have a strategy for looking at that. You look at the options and you do it. And you just don't adopt something because it's a fashion statement. You think it'll be happy, the street will be happy, because you will have to connect everything you're doing to shareholder value. And that means looking at your expense and your cost and the flexibility of that versus what's going on with your enterprise if you're for profit. And if you're public organization, governmental, there are a whole bunch of other considerations there.
Yeah.
And there's always the risk profile and the cyber profile. So you can't jump into all this stuff blindly, no matter how trite that sounds.
And in terms of some of these points that you're making, there was a chart that came out from Citigroup that showed the capability of a bunch of LLMs, the cost of those LLMs. And at the top, the most capable are Anthropic and OpenAI, but they're also the most expensive. So there's your tokenomics at play. How do you manage that cost? Well, a couple strategies here. There are several models that have nearly the same capability at much lower price points. And so I think the Citadel Group also just had a piece come out that showed the cost of a lot of these variable tokens are starting to fall. So it would indicate that people are starting to look at some of these alternative strategies, where they're either going to the lower cost models They're moving it on to on-prem. So I do think the shift is starting to happen. You're starting to see, because of what has happened with Uber, what has happened with Microsoft, people are shifting to much more of the business outcomes, and they're recognizing that they have to do more of that control of their cost base. I think they're going to use tokenomics where it applies, but they can still use some of the more traditional strategies to manage cost and deliver value. And that's where I think the connection to TBM can be really valuable.
Yeah, and I put this a little bit different way, because in the U.S. right now, staying out of the politics, affordability is a key to consumers right now. You're going to have to look at AI affordability, and AI affordability means looking at all these factors. So you can get lost in spending, you can blow your entire budget in 3 months, but was it worth it? And that's the issue about it.
Yeah.
So you have to look about AI affordability in the economic model for your company. What can you afford? Right now, with IT inflation, forgetting about tokenomics and AI, without all that, IT inflation is higher than the average budget increase. So now you're adding on new ways of spending money and getting value. What can you afford? How much can you load per share for a public company with the addition of AI? What does that do in terms of your AI risk factor, which means if you don't get results, how does it tank your earnings per share? So there's a whole stack of measures you need to do. And the real issue is, just like in a house with a mortgage or owning a car or anything else a consumer does, what is the AI affordability? And the vendors can lower their costs, but what's going to happen to the vendors when they keep squeezing down their costs? They've invented $2 to $3 trillion to build the infrastructure to run all this stuff and build the models. It just turns out, when you do the math, the world economy will have to grow from 130 trillion to 180 trillion in the next 5 years, a $50 trillion increase in the size of the economy to have enough money to buy the stuff. And if they lower their prices, their margins are going to go down. So who's going to tank first is the contest I would have.
Well, and that's to that point. Bloomberg just had an article that came out the other day that was talking about how OpenAI is going to drastically reduce their token costs. And, so the question is, will Anthropic follow? And then the question then becomes, what about all of these infrastructure players, right? Because it's like you said, they're all the economics and the financing and things like that have been very interesting of how they've all propped one another up. But that'll be good for your affordability crisis, though, because the consumer in that type of model at one level will win, not if there's a big stock market impact, but if the affordability of some of these AI tools and things like that come down, you got to realize you can get a little bit more value out of your deployments.
Yeah, an interesting little set of numbers. If you go back in time, OpenAI said by 2030 they'll have an $800 million shortfall in revenue. What happens when they lower their prices, lower their costs?
It's going to be $1 trillion or more.
Elon Musk and SpaceX for a loan or something with shares of that. I don't know how it's going to work, but the economics, you need to have, again, you have an organization, you need to have a stable base of vendors supplying you with stuff, and you need to worry about their long-term viability. And here we're in a highly speculative market, and we've seen what happened with Bitcoin and everything else. And this stuff, this is going to sound strange, but this is like could be the Bitcoin of computing right now. It's going to ride up and down in waves.
Another analogy, a little bit more maybe you're in my era, Howard, is, I've heard people talk about, Enron in terms of some of the way the financial mechanisms are working and things like that. We hope it's not. We hope that AI is going to deliver a load of value. I think the big takeaway from this one is tokenomics, probably here to stay, but it's not the only answer. It's part of a hybrid answer of how you need to think about delivering AI and then expanding on that. I think your AI affordability point is fantastic. What can you deliver at a price point that you can live with and still create value? So great conversation today, Howard, as always. Appreciate you joining us. We'll get on to our next podcast here in a week or so, but you can find us on Spotify, YouTube, anywhere where you get podcasts. Give us a like if you would. Any last words, Howard?
Yeah, I just said all the questions you're asking, Matt, are great, and not to advertise the point, but this is what technology economics is all about, and this is what models of TBM aspire to be able to help us do, is to sort through all this, the affordability, and connect outside in what value you're trying to get to what you're doing on the input side, and the other way around, when you have new offers of new technologies, what value might they create? So you need to do this from two directions at once and figure out where to invest and understand. At the end of the day, this comes down to true economic terms, and you have to understand technology cost of capital and all these linkages. So it's the birth of a new field. So companies shouldn't feel bad if they haven't come to grips with it.
Yeah.
But this is new thinking in a different way in terms of consumption being such a major part of your IT spend. So thanks a lot.
Fantastic.
Okay.
Great stuff, Howard. As always, great seeing you. We'll talk to you soon.
Thanks a lot, Matthew.
Bye now.